In Pakistan, designated non-financial businesses and professions, DNFBPs, play a vital role in combating money laundering and terrorism financing. Their regulation is a key component of Pakistan's efforts to comply with Financial Action Task Force (FATF) recommendations and strengthen its anti-money laundering (AML) and counter-terrorism financing (CTF) framework. Overview of DNFBPs in Pakistan. DNFBPs are defined under Pakistan's Anti-Money Laundering Act 2010, AMLA, and other relevant regulations. These entities are considered high risk due to their exposure to large, complex, or cash-intensive transactions that can be exploited by criminals. Types of DNFBPs in Pakistan. According to Pakistan's AML-CTF framework, DNFBPs include 1. Real estate agents, facilitators in property buying, selling, or transferring ownership. 2. Dealers in precious metals and stones, businesses dealing in high-value goods like gold, diamonds, or jewelry. 3. Lawyers, notaries, and legal professionals involved in financial or corporate transactions on behalf of clients. 4. Accountants and auditors providing financial management and consultancy services. 5. Trust and company service providers, TCSPs, engaged in setting up or managing legal entities. 6. Nonprofit organizations, NPOs, high-risk entities that may be exploited for terrorism financing. Regulatory framework in Pakistan. Pakistan's AML-CTF framework has undergone significant improvements to align with FATF recommendations. Key regulations impacting DNFBPs include 1. Anti-Money Laundering Act 2010 MLA governs the identification, reporting, and mitigation of money laundering risks by DNFBPs. 2. AML-CTF regulations for DNFBPs 2020, issued by the Financial Monitoring Unit (FMU) and sector-specific regulatory bodies like the Securities and Exchange Commission of Pakistan (SECP), defines obligations for DNFBPs such as customer due diligence (CDD), record keeping, and suspicious transaction reporting. Role of SECP and FMU. The SECP monitors DNFBPs like real estate agents, jewelers, and accountants for compliance. FMU processes STRs and coordinates national-level AML-CTF efforts. Obligations of DNFBPs in Pakistan. DNFBPs are required to implement measures to identify and mitigate money laundering and terrorism financing risks. Their obligations include 1. Customer due diligence, CDD. Verify customer identity and beneficial ownership. Conduct enhanced due diligence, EDD, for high-risk clients or transactions. 2. Suspicious transaction reporting, STR. File STRs with the FMU when transactions appear unusual, suspicious, or inconsistent with the client's profile. 3. Record keeping. Maintain records of transactions, CDD, and correspondence for at least 5 years. 4. Internal controls. Establish AML-CTF policies and appoint compliance officers. Conduct regular training for employees. Screening against sanction lists. Ensure no transactions involve individuals or entities on sanctions lists. Risks of money laundering in DNFBPs in Pakistan. DNFBPs are particularly vulnerable to money laundering and terrorism financing risks due to cash-intensive transactions. Real estate and jewelry sectors often involve large cash payments that are difficult to trace. Complex ownership structures. Trusts, companies, and shell entities are used to obscure the origin of funds. Cross-border transactions. Non-resident entities may exploit weak regulatory oversight for illegal activities. Under-regulation in some areas. While Pakistan has strengthened oversight, certain DNFBP sectors still face gaps in enforcement. Challenges for DNFBPs in Pakistan. Awareness and capacity building. Limited knowledge of AML-CTF obligations among DNFBPs. Informal economy. Pakistan's large informal sector complicates transaction monitoring. Weak enforcement. Despite regulations, enforcement of penalties for non-compliance remains inconsistent. Global sanctions pressure. Compliance with FATF requirements is critical for avoiding international sanctions. Recent developments. FATF compliance. Pakistan was removed from FATF's gray list in October 2022 after implementing significant AML-CTF reforms, including tighter regulations for DNFBPs. Technology adoption. Regulatory bodies have introduced online tools for STR filing and compliance monitoring. Sector-specific guidelines. The SECP and FMU issued guidelines tailored to DNFBPs to ensure sector-specific risks are addressed. DNFBPs in Pakistan are integral to the country's fight against money laundering and terrorism financing. While significant progress has been made, challenges like limited awareness, informal practices, and enforcement gaps persist. Strengthened regulations, capacity building, and consistent enforcement are crucial to ensuring DNFBPs comply with AML CTF obligations and contribute to Pakistan's global compliance efforts.